Welcome to the HFR Podcast. My name is Erik Norland, and I lead HFR Media. HFR is the established global leader in hedge fund data and analysis since 1992. To learn more, visit hfr.com. Welcome to the HFR Podcast. Our guest today is Erik Norland, who is Managing Director and Chief Economist of the CME Group, arguably the world's leading derivatives marketplace that can trace its history as far back as 1848. Erik is one of CME Group's spokespeople on global economic, financial, and geopolitical conditions, and he has 15 years prior experience in investment banking and hedge funds in the United States and France. Erik, a very warm welcome to you on the HFR Podcast.
Well, thank you so much for having me.
So I'd like to start by getting a lay of the land. April 2025 saw market volatility and economic uncertainty, the likes of which we can count on one hand in the past. What market dynamics did you observe in derivatives in this time period, and how do they compare to past great crisis periods?
Right. So, I think that what happened in April, one of the things that was very notable about it was the correlation of the markets. Normally during crises, we've had a lot of periods in which there have been negative correlations between stock prices and bond prices. For example, if you compare to, say, the global financial crisis or even the LTCM meltdown in the summer of 1998, at that time you had stocks falling and bond yields falling, which meant, of course, that bond prices were going higher. This time, this past April, we had a number of days in which equity prices and bond prices were falling simultaneously, along with the U.S. dollar as well. Sort of very different correlations than we had seen. And I think that reflects a differing fear on the part of investors. During the LTCM meltdown, the global financial crisis, investors were primarily concerned with deflation, with defaults on the part of companies, and therefore there was this huge flight to quality into bonds. This time, the fears are still kind of what we've seen a lot in the post-pandemic world, like we saw much of the time during 2022 when we had an equity bear market back then. The fear is now more centered towards inflation or potentially stagflation, which is why you're getting simultaneous movements in the equity and bond market in the same direction. And I think that has a lot of implications for investors. During the period from 1998 until maybe 2021, stocks and bonds in general usually had a negative correlation. And that was great for these 60-40 long-only portfolio managers in those two markets. Now that correlation has gone back positive, it means that the diversification inherent in the 60% equity, 40% bond portfolio is less now than it was previously, which I think increases the attractiveness of hedge funds and other alternative strategies that can take long-short positions.
So thinking specifically about futures markets, can you elaborate on that a little bit?
Well, the markets, I would say, functioned extremely well in the month of April. But you have to remember that derivatives markets, futures and options derive their value from underlying securities and equity markets or U.S. Treasury markets. And there's really not a lot of divergence between the two markets, because any divergence is arbitrageable. So essentially, there's really no divergence between those two markets except for the accumulated cost of carry and expected carry for like dividends and things like that are sort of automatically priced into futures prices.
Sure. So thinking about commodities now, what's been striking about the proposed tariff reforms has been their seeming sort of uniformity across the board in that they're applied to literally all trade partners of the United States. Where have they hit hardest in commodities?
Yeah, so we've seen very different tariff impacts on different commodities. I think that hit hardest on the downside so far has been the energy markets. Energy prices, especially crude oil prices, and by extension, the prices of refined products like crude oil and heating oil, or ultra-low sulfur diesel as it's now called, have generally been to the downside. The assumptions in these markets seem to be that a global trade war could slow global economic growth and therefore produce less demand for energy. And it's also hitting the energy market at a time when there's tremendous headwinds anyway. because you have a tremendously rapid adoption of electric vehicles around the world, increasing use of hybrids, slower economic growth in China, and also OPEC Plus beginning to lose discipline in their markets. By contrast, we have seen tariff impacts on things like steel and aluminum, where the prices at times have gone higher because, especially for contracts that are priced in the U.S. market, it could mean higher prices for those kinds of goods.
So one of the things that interests me as a macroeconomist is this idea of propagation of a shock. And in particular with options and futures, timing is what it's all about. So what is the expected length of time, especially with the tariffs on reprieve currently, that you would expect to see before the full extent of these policy changes is realized across markets?
It's really very, very difficult to say. I think, first of all, we have to see, what sort of tariffs ultimately result. And the policies are still changing from time to time, from day to day. But I would think it would probably take several months for it to feed through into economic data. For one thing, during the first quarter, one thing we observed is that there was a tremendous rush to buy imported goods in the United States. So the amount of imports into the U.S. surged in the first quarter. The counterpart of that was we also saw stronger consumer spending as consumers also, in some cases, went out to buy goods that they suspected might ultimately be hit by tariffs, anything ranging from automobiles to olive oil. And so all of this created this surge in imports, which detracted from Q1 GDP, since imports are subtracted from GDP. But the sort of flip side of that, the other side of the coin, is that business inventories rose. As businesses imported all of these goods, their inventories increased. And so now I think a lot of businesses are now asking themselves the question, well, how much more can we charge for these inventories that have been brought in? Can we in fact raise the prices? And I don't think there's probably a uniform answer to that question. It probably varies from one business and one product to another. Businesses sort of attempt to gauge the strength of consumer demand. And, even going into this whole period, there were already signs that U.S. consumers were kind of flagging in terms of their ability to buy more goods. For starters, we've seen sharp rises in delinquency rates on automobile loans, on credit card debt over the last few years. And you have to remember that as of May 1st, of course, student debt is also now coming due in the United States. So the question is kind of outstanding is, how much can the consumer bear in terms of potentially higher prices? And can the businesses, in fact, pass these price increases on? And so all this creates really, really complex dynamics for the markets. If they do pass the cost on, that could mean higher inflation, which could mean higher bond yields, perhaps fewer Fed cuts. If they can't pass it on, that could mean lower profit margins. And so the markets are still trying to figure this out, and I think they could remain unsettled for several more months.
So from this unique vantage point that you have, how do you reflect on the assessment of stagflation becoming a possibility in 2025?
Well, I would argue that we've really been in stagflation ever since the pandemic ended, to varying extents. During the pandemic, we spent $5.9 trillion in the United States on COVID relief. The Fed printed a similar amount of money to buy all of that Treasury issuance, and we topped that up with the Inflation Reduction Act, the CHIPS and Science Act, and so we had this surge in inflation. The economy, has continued to grow. Inflation has come down, but I think that we're still in a period in which inflation expectations are still playing an important role. For example, if you look at the University of Michigan's Consumer Confidence Survey, it's just 1 month's data, by the way, for a single month, but it showed that consumers expected 6.7% inflation over the next 12 months and 4.5% average inflation over the next 5 years. You contrast that with the bond market, where you look at the spreads between TIPS and U.S. Treasuries, and those are pricing an inflation rate of closer to 2.3 or 2.5%. So there's a big disconnect between what consumers tell surveys that they're expecting and what the bond market is saying that it is pricing.
Absolutely. So you have a recent piece comparing U.S. corporate investment grade bonds to equities and treasuries. Would you elaborate on that a little bit in terms of how these different asset classes compare?
Yeah, absolutely. So first of all, the motivation for writing the paper is we recently launched futures contracts on both high yield bond indices and spreads, as well as investment grade indices and spreads. And Prior to the launch of futures contracts, it was always kind of hard to leverage up corporate bonds to equity-like risk. And so there's a number of, I think, interesting and surprising outcomes to this research. First of all, in general, high-yield bonds have a lower volatility and lower risk than investment-grade bonds, which is very counterintuitive. But the reason is they typically have much shorter duration. So the high-yield bond index, a Bloomberg very liquid high-yield bond index, has an average duration of 3.34 years. The Bloomberg investment-grade bond index, or corporate bond index, has an average duration around 6.8 years. So the investment-grade bonds are much, much more sensitive to interest rate risk than are high-yield bonds. By contrast, there can be periods, especially during times of acute equity market stress, when the equity market's having a very big sell-off, when you can have higher volatility in a high-yield market than the investment-grade market. And so the other thing is that prior to the launch of futures contracts, risk parity portfolio managers and hedge fund portfolio managers who wanted to leverage these up to equity-like risk had trouble doing so. But one thing that we've seen, though, is that these bond markets, when you sort of leverage them up to equity-like risk, have actually gotten very, very strong returns over so far this century. They've had very, very strong return profiles that on a risk-adjusted basis have outperformed both U.S. Treasuries as well as the U.S. equity market.
So it's interesting to me because it represents disintermediation of large corporations that can issue these investment grade bonds and high yield bonds from not only traditional banks, but also the equity markets. Do you think that this sort of reduces the Fed's ability to act for its dual mandate? Or is it just another way of creating more liquidity in the market for these larger corporations and allowing them to be more insulated from economic shocks?
Well, the corporate bond market has existed for a very, very long time, but it has grown a great deal over time. I mean, for example, there was no high yield bond market until the 1980s. And for a long time, the high yield bond market kind of traded by appointment. It was not a super liquid market until I would say about 15 years ago. And since then, we've seen a dramatic improvement in its liquidity. And so I think what this is doing to monetary policy is it's probably making it so that when the Federal Reserve moves rates, it takes a longer time for the consequences of those moves to impact the economy. As corporate bonds become a larger and larger share of total debt issuance, and as the maturities on them may lengthen over time, when the Federal Reserve raises rates, it may not impact corporate funding costs, for several years.
Absolutely, yeah. Okay, so let's switch gears to another investor favorite, which is gold. You have, again, a unique insight into the gold market, and I wonder if you could elaborate on the fundamental factors today of these movements in gold prices that we're seeing.
Yeah, so today, on the day that we're recording, gold prices are down 3%, which is a pretty big down move. But the prices, as of this recording, is still around $3,200 an ounce, which is roughly double what it was 2.5 years ago when it got down as low as $1,600. So gold, I think, has been in a generally favorable environment for a variety of reasons. So first, despite the fact that inflation rates have come down, in most countries, they are still running above target. In the Eurozone, the US, the UK, core inflation rates are anywhere from 2.5% to 3.5%. Central bank targets are only 2%. Despite the fact that inflation is still running above target by most measures, central banks have been cutting interest rates in a very, very rapid fashion, especially in Europe and in Latin America. Not so much in the US, where the Fed has cut 100 basis points, but it's been a little bit more hesitant to cut rates rapidly than some of its peers. But then on top of that, you have numerous very, very large countries that are running enormous budget deficits. 7.3% of GDP in the US, 4.5% of GDP in the UK, 6% in France, 7% in Italy, 6% in China, 6% in Japan. And most of these countries have no plan to either raise taxes or rein in government spending. And so the result of this is investors are looking at these fiat currencies and are saying, wait a minute, the inflation rates are still above target in most countries. Central banks are easing policy despite the fact that inflation is still running hot, and these countries are running enormous budget deficits. So there's kind of this search for alternatives to holding fiat currencies like the dollar, the euro, etc. And the main alternative is still gold.
Well, one of the most intriguing markets that I think the CME now offers is crypto digital futures. And that's an asset class that's plagued by risk of almost every variety, as well as several accusations that it is nothing more than a purely speculative instrument, which in itself may or may not be a bad thing. What are the fundamentals of the digital assets market, and what insights does price discovery yield there?
Yeah, so I think that there's a number of different digital assets that trade on our exchange, and they're in some ways very different than one another. So you have Bitcoin. Bitcoin is in some ways the purest analog to gold, in the sense that gold doesn't have a great deal of real life uses. Like, yes, there are tiny bits of gold present in your computer or in your smartphone. Of course, it can be used for jewelry, which I would argue is actually a form of investment for the most part, even though it can be very nice looking. But gold, by and large, is stored as a unit of value. The vast majority of it is owned by central banks. It's stored in vaults. It's not really used for any industrial purpose. Bitcoin kind of serves an analogous role within the crypto universe. And Bitcoin, as we've pointed out in articles, has its own specific economics. First, it has almost like perfectly inelastic supply. So it doesn't matter how high or low the price goes. The Bitcoin algorithm is determined in advance how many coins will exist at any given point in time, which I think explains in some ways why it's so volatile, because of that incredible price inelasticity of supply. And then secondly, Bitcoin also has its own kind of specific relationship with certain factors, including the amount that miners charge to validate transactions on the network. In the past, when we've seen spikes in the amount that they charge, Bitcoin prices have often fallen into bear markets. And then lastly, you have the phenomenon of the Bitcoin halving. Every 4 years, the amount of new supply drops in half. That happened just about a year ago at the end of April 2024, where we went from 330,000 new coins a year to 165,000. Now, you contrast that with things like Sol or with Ether that actually are used in smart contract networks. They have very different supply mechanisms, very different rates of transactions. And similar for XRP, where the coins, were basically created in advance of, in advance rather than being mined like Bitcoin, are created as a part of proof of work or proof of stake, like Ether or Sol. So they all have their own very unique economics. They tend to have a positive correlation with the NASDAQ 100 future. They tend to have a slightly negative correlation with the US dollar. So to some extent, they are also being viewed as a proxy for technology stocks and as an alternative to the US dollar. That relationship is not always very strong. And then finally, they often have a very weak, but nevertheless slightly positive correlation to gold. And that, of course, is especially true of Bitcoin. So in some ways, as economic assets, these are hybrids of a variety of different concepts. It includes sort of elements of equity, precious metal, and currency.
So my last question to you is shifting gears a little bit again. I think one of the less discussed but equally impactful policy changes underway with the new administration is in the area of climate change and sustainability. What are the factors to consider in the energy transition that will be most impacted by policy change and a shift of trade patterns?
Well, that's a tough question because, what we've been seeing over the last few years, that I think is quite remarkable, is that up until the end of 2022, copper and oil prices generally did the same thing. So during periods of high oil prices, copper tended to be expensive. And during periods of low oil prices, copper tended to be rather cheap. And my hypothesis was always that was because copper is very energy intensive to mine. And so because of the incredible energy intensiveness of mining and refining copper, it tended to follow the price of energy. But since the end of 2022, which is around the time that the US passed the Inflation Reduction Act, there tended to be this huge divergence. But I think it's important to remember there's a lot more at stake here than just US public policy. We also have a tremendous growth in electric vehicle sales in China. Electric vehicle sales are surging in Europe and many other countries around the world. So we're seeing kind of sustained demand for copper prices, which have generally been strong over the last few years. And of course, more EVs mean less demand for crude oil. So we're seeing this enormous divergence. And I'm not sure that changes in public policy in any one country are going to be enough to throw off that dynamic.
So, Erik, what are you working on in terms of research right now?
Well, one of our most widely read papers from a few years ago was on the relationship between the Russell 2000 small caps and the S&P 500. So I'm working on updating that because small caps have suddenly become extremely inexpensive relative to larger capitalization stocks. And we're going to take a look at XRP as well as sort of what sort of indicators to look at to see how inflation might be feeding through the economy.
That sounds fascinating. I have to say, your website is one that I can get lost in for hours. There is so much good stuff in there. So I will be sure to keep an eye out for those articles.
Well, thank you so much.
Erik, thank you so much for sharing your insights. It really is wonderful to have you on the show, and I am so glad you could make the time.
Well, thank you so much. And I hope that the rain here in the background didn't come through on the microphone. Here in London, we were having the most beautiful day. And then now I think we're actually having sleet. It's actually like huge ice cubes falling out of the sky. Hopefully it's not coming over the mic.
I think it's just picked up, actually. I think it's just started to really pour.
Yes, it's wild out there, let me tell you.
Well, I hope you have a wonderful evening. Thanks again.
Well, thank you so much.